Hey everybody, good evening. Marty Mazzora, 6th of March 2018. Video commentary for you. I'm inspired to do this because of the news that hit after the close of the market today, and that was that Gary Cohn, the chief White House economic advisor, has resigned. He chose to do so because he had fought adamantly against the recent decision to announce tariffs on steel and aluminum against our trading partners and on behalf, apparently, of the steel and aluminum industries here in the United States. In our year-end letter, in, of course, review meetings with clients and much of the commentary we'd offered up lately here on the blog, we expressed our concerns with regard to the protectionist rhetoric. So the tariffs were one thing. Gary Cohn is a legitimate character in the economic world and gets the importance of global trade. So him resigning has got the market kind of in a tizzy. Dow futures have been moving somewhere between down 420 points to down 270 points if the market were to open right now. I don't know what happens between now and the morning. I suspect it'll be quite noticeable to the downside. So I want to put volatility into perspective. I want to show you a little bit more of the charting we do each week, and we'll keep our heads about us. What we're looking for over time is a breakdown in our fundamental analysis, which remains very strong and very market friendly at the moment, as do the longer term technicals. Certainly this decision on the tariffs, as we know, and then now Gary Cohn's resignation is going to test the short-term technical picture. But folks, I can tell you that in the heat of the volatility is not the time to make adjustments. The time to make adjustments is when whatever's causing the volatility or just the course of economic events begins to show us in the data that it's time to take on a more defensive posture. And that's clearly not what we're seeing just yet. But of course, this is new information for the market, so we'll see how it reacts. In terms of corrections, here's the one we're in. We had the peak on January 26th. We had a swift 10 plus 10.01 or 2% decline in the S&P 500. Came out of that all along. We've been reminding you on the blog that this would be one of the swiftest, weakest corrections in history. And coming off of such a long, strong market with no volatility, it would be very unusual if this is all we get. So with or without protectionism, with or without the resigning of a chief economic advisor to the White House, we could very easily be seeing multiple 100-point drops in the Dow and like percentage point declines in the S&P and break this bottom here and move further down for several more weeks to go. That would be just the norm in terms of historic corrections. So regardless of the reason, we've expected that things could break down and get somewhat worse before they get better. Again, that would just be the normal course of events if history is to be our guide. Okay, so now we're looking at a daily chart of the S&P 500 for the last 2 years. This is a chart that we update at the beginning of each week, and we apply a number of indicators to it. I've been using the Fibonacci retracements from the Brexit low back in 2016 to kind of get a feel for what we might expect in a normal correction in terms of coming back and retracing some of the nice rally that we've had since then. So here is where this rally within a long-term bull market has begun. And here you see the S&P testing its long-term trend indicator, the 200-day moving average. We came out and we obviously peaked on January 26th, and we came off of that with this correction. Folks, typically strong rallies in the market retrace, and there are some key technical levels that traders watch out for: the 38.2, the 50, and the 62% retracement levels, and then of course the 100% retracement levels, which can happen in rallies even within the context of an ongoing bull market. The 38 and the 50 tend to be pretty strong support, and as you can see, ironically, on February 8th, coming off of that high, right on the 38% retracement, plus right at the 200-day moving average. So you had two layers of technical support. So a good technician who trades the market or times the market should have been buying very heavily right there. And sure enough, you can see they did that, and the market has seen a very nice bounce since. We've been expecting easily to penetrate this 38.2 and maybe even get down to the 50% retracement level, which a lot of technicians regard as very strong support within the context of a longer-term bull market. So we'll see if the latest news or any other catalyst brings us down to that area. So folks, this little illustration here, though, just basically shows that this is a very normal sequence of events. You can see testing the 200-day moving average, and I can go further back, is a very frequent event. We went a very long time, a record long time, quite frankly, without much volatility. Now we're getting it. Again, we continue to think that it's norm. In fact, it's healthy after such a long string in terms of days without a 3% correction. And here's the 5-year daily chart. Now, this is the chart we use for our formal technical analysis, and I've shown you that spreadsheet here on the blog before, where we track the 50, the 100, and the 200-day moving average. We look at their positions, we look at where the market's trading relative to those, and then the slope of the indicators. Fast moving average is ahead of the slower moving averages. That's a bullish setup. When particularly the 200-day is trending in an upward direction, that's bullish as well. Here's that test that we just looked at. Right now, the S&P, after coming down below that, came back up, came above the 50-day moving average. And this was recovery from that correction, at least it appeared that. And then the tariff news seemed to be the catalyst for this decline right here. Tested the 100-day, came back. These are areas that technicians are actually coming in and buying. Overnight, it looks like we're going to see this market come down and maybe even test the 200-day once again. And as you can see, there are even periods within this bull market where it actually breached it quite noticeably. These are corrections in 2015, and then the worst start to a year ever in 2016. This is that long consolidation that covered 2014, 2016. So we broke out of that finally with quite a bit of momentum, and now we're moving in an upward sloping trend line. So now I want to zoom out and show you a much longer term chart. This is a 30-year, actually it's a 33-year, and you'll see why 1995 in a minute. Monthly chart of the S&P 500. So here's that 2014 to 2016 area where we consolidated after a real nice run right here. This would be a very long-term consolidation box that actually encompasses the last two bear markets, the tech bubble bursting and then the real estate and mortgage bubble bursting here. But if you go back all the way to 1996, you can see we entered this zone, topped, came down, bottomed, topped, came down, and really found ourselves locked within a multi-year consolidation before we broke out with some force. Once again, recent consolidation, breaking out, and here we are today. So folks, obviously what we're doing with these charts is we're looking backwards. We're looking at recent history, and then we look at the long-term past to try to get a feel for correlation similarities in terms of what we're dealing with today, what we dealt with in prior years. In fact, there's a very strong correlation between the action in 2017 and the action in 1995, which was right in here. Ironically, that period was coming off of a 2-year consolidation period, looked much like the one I just showed you where the market's bouncing around. And previous to that, a very long period of consolidation back here in the early 60s all the way through to the late 70s that had some real rough markets along the way. The difference between the two, though, is that notice how far removed the 1995 period is from that long consolidation box versus where we are today, coming out of a very long consolidation from the mid-90s all the way up to 2013 or so. Again, similar looking move coming out of here in 2017. Here we are today. Now the question being, what happened after this? Very similar look, very similar period, very similar consolidation, big strong breakout. Where were we in time with this bull market right here in 1995 that correlates close to the time we're in currently? Well, as it turned out, we had quite a ways to go, another 3+ years in this bull market before we finally reached that peak in the economy and we had the tech bubble burst and we had a really rough bear market right in here. And I was there to experience that, by the way. So what we're seeing now, though, looks more like this. I'm not making any prediction. Of course, I'm making no guarantees about what's going to happen in the future or how long the current bull market will last. But I can tell you it is certainly within the realm of historic possibilities that we've got a ways to go yet. And that's consistent with our technical analysis. And it's also consistent today with our fundamental analysis. Of course, things are always subject to change. We'll keep an open mind and we'll be looking for the kind of stress in the market that tells us that we need to begin incrementally making some changes when probabilities suggest that we have more downside risk than we do upside risk. Right now, I think we have a lot of near-term volatility risk, which we're experiencing as I speak. But we've got to wait for the conditions to deteriorate before we really begin making serious incremental changes, and we're just not there at this juncture. Okay, so in closing, one more technical indicator. I don't believe we've shown you this one yet. We show you the monthly MACD, which we put into our formal technical analysis, but we also respect what are called the Bollinger Bands, and that's what you have in front of you. Again, this is a monthly chart. John Bollinger, market technician, great deal of respect in the investment world. He created these bands that encompass the 20 period moving average. So on a daily chart, it's a 20-day moving average. This is a monthly chart, so it's the 20-month moving average. This is 2 standard deviations away. So we've got a kind of a range, kind of an envelope here that the market tends to live within. Again, the 20 period moving average, this is a 20-month moving average, 2 standard deviations away from that. Now, the signals come when the stock, or in this case, the S&P 500 index, penetrates the center line, the moving average here. But it's also a pretty strong line of support. See here, this 20% correction in 1998, which we talked about a lot here, happened when Russia defaulted on its sovereign debt. We had a Thai currency crisis. We had a big hedge fund implode. It's a pretty scary time. A lot of risk, particularly in the credit markets, financial markets really tanked. But we didn't have bear market conditions. When we backtested our PWA index, it was still very green at that point. So we got a big correction, but it turned out to be volatility to ignore for long-term investors. Notice the very positive slope. That says that we had a lot of momentum going in an upward direction. Here you had the market begin to peak when the tech bubble began to burst. You had us come through, penetrate the 20-day moving average. Notice how much flatter it was here. You can tell momentum was waning, even though you're coming right off of all-time highs. And as it rolled over, so did the market. We had a very dramatic bear market decline, particularly if you were in NASDAQ stocks. Notice here, the market coming back, conditions got better. We've shown you our index test here as it began to turn green. Came back up through the center line, kind of played with it for a little while. This turned positive, and we were off to the races with another nice several-year bull market until the credit markets began to unwind, broke through it. You notice we had still a pretty good-looking trend here. Therefore, the market bounced off of that. But then as everything rolled over, it rolled over again. So this is what a bear market setup looks like on this particular pretty reliable long-term technical indicator. Here's what it looks like there. Here's what it looks like again in the mid-2000s with the real estate bubble. Here we are coming out of that, and here we've been ever since. We had that correction in 2011, but we had a good strong upward slope, good technical trend, a few tests along the way, 2014, those corrections in 2015 and 2016, but again, you did not get a rolling over of the moving average, and here we are, positive, a lot of momentum. Look, here's the current correction, here's the market coming back. So folks, what we do here is we just have to ask ourselves, does this here, with this slope and where this price is testing the upper bounds, does this look more like these periods here, where we're about to roll over into a bear market? Or does it look more like these periods here, where we had a lot of momentum, good strong bull market? It instructs us to stay the course, stay growthy and cyclical with our allocations, pay very close attention to the volatility and see if any cracks begin to form so that we might need to make some changes. But as I sit here and report to you this evening, notwithstanding the news on the tariffs and the economic advisor again resigning today, certainly the makings for some volatility, but we've got to see real data begin to deteriorate before we begin making moves that are something other than reactionary moves, which we absolutely do not want to make. Imagine making those reactionary moves in here and what it would have cost us when the setup looked like this. Different story here, and that'll require a different narrative from us and different actions as your portfolio managers. So I'll leave it there for this evening, folks. I'm sure I'll be back tomorrow with something that I think can help you put these things into perspective. So look for more very soon. Thank you as always for watching and listening. Bye-bye.